This is Jonathan Mickles with the Strategic Multifamily Investing Podcast, and I have with me today Mr. Brett Swarts. How's it going, Brett?
Jonathan, better than I deserve. So good to be here. Thank you for having me.
Excellent, excellent. So, been looking over some of your media here. You've got quite the quite the story. Let's see if we can start a little bit, way back when. Did you have an interest in real estate or in finance primarily that got you here?
It was real estate. I grew up in the Bay Area with my parents, kind of the Silicon Valley, East Bay of California. Big 49er fan, by the way. We're recording this and the 49ers are going to be playing on Sunday, so I'm hoping that they win the Super Bowl. But we grew up there, just falling in love with the sticks and bricks of real estate. My parents built houses mainly and then had rentals. And so all through the Bay Area. And I saw my dad and my mom be entrepreneurs, build something from the ground up. And I just loved seeing a project that was completed from start to finish. So that was a really young age, how to work hard, how to have a vision, how to work through challenges with real estate. And then fast forward, my brother and I are the first to graduate college on either side of the family. So my parents said, look, we worked really hard, but we want you to go get an education. I'm like, yeah, it sounds really great. I also played basketball in college. So that was a big passion of mine. So I played hoops. And then I had a chance to now study the finance of real estate by going to a place called Marcus and Millichap. And
Okay.
so I went from the sticks and bricks of development to the numbers and underwriting and understanding how to put a deal together, negotiate and broker and add value and all the ways that are associated with, finance of multifamily real estate. And so Marcus Millichap was a great place to study as well as practice. So I was there for 5 years, but I
Yeah.
wasn't
Now,
always,
you
yeah,
were you were a broker at Marcus
yeah,
Millichap, or you
yes, sir.
were okay? All
Yes,
right.
sir.
And so did you have a specific type of commercial real estate that you were working with, or was it all multifamily?
All multifamily, yeah. So strictly
Oh wow.
multifamily, anywhere from 5 to 100 units, right? We were kind of in that segment in Sacramento at this point. So just looking at the different kind of the 5 counties of that area and trying to grow the business, right? Help people transact, do 1031 exchanges, and things were good for a little while until the '08 crash. So I started in '06. And I went from making just a little bit of money to almost like nothing overnight. And if you've ever been there, I was kind of the real estate wannabe. Like I was still just trying to make it in this business. I went from being very successful in high school and college for sports and in degrees to making like next to zero because it was 100% commission.
Right.
So wife and I found ourselves flat on our back financially, moving my brother into his small condo and working side hustles. My side hustle was Cheesecake Factory. So I'd work nights and weekends at Cheesecake selling avocado egg rolls. And by day, I'd make
Mhm.
cold calls and try to negotiate with banks. And so I was going through a big financial struggle, but I was also growing a ton. But my
So
clients were all, yeah, go ahead.
so you said you were negotiating with banks, so you were doing workouts, if you will, of problem
Yeah,
multifamily type
exactly.
deal?
Trying to extend loans, trying to,
Okay.
basically that was the main thing, right? A lot of multifamily actually survived pretty good unless you had too much debt, not enough liquidity. People actually, if they could hold on, and that was mainly the conversation is say, hey, look, try to make as much payments you can on time and try to work out with the banks, but also we'd work with the counties for the property tax reassessments, right?
Okay.
We'd work with owners to try to help them with their rental collections or their, implementing RUBS or implementing anything that could just get a little bit more income, right? Because
Yeah.
things were starting
Yeah.
to drag at that point. And so the crash taught us two things. Number one, the 1031 exchange is not always your friend because people were overpaying for properties in these short period of times. And they felt great to be a seller, but they hated to be a buyer. And that's what created this perfect storm of the people who actually lost all of their wealth or half of it was those who had too much debt, not enough liquidity, and they overpaid for the properties, right? And so I
Mhm.
had one client in particular, he lost $50 million of multifamily real estate. He was very hands-on entrepreneurial, but he had too much debt. And I saw that pain of that cycle and the pain of my clients. So we said there's got to be a better way.
So then let's go back and talk about what too much is. What is too much, if you will, in terms of debt equity for, in general that you would recommend on
Let me
any of
give
these
you,
deals?
yeah, let me give
Go
you the
ahead.
monopoly, right? We grew up playing Monopoly, Boardwalk, Park Place, the different areas. Here's how we believe you can basically be very conservative and grow massive amount of wealth. All you ever do is not borrow more than 50% of the total value of the
Okay.
property, right? And then you go and buy more property. And if you never sell and just collect the pieces around the boardwalk and you only ever acquire and you only ever leverage up to 50%, then you're in a nice position to probably grow your wealth substantially over a period of time. However, there are times to sell and there are times to take on debt. There's times to take on smart debt and there's times to get out of debt. And it's really understanding the three kind of flows. Most people know cash flow, right? But most people aren't necessarily specialized in tax flow. And the third one is debt flow. We took debt flow for granted for many years, Jonathan, because debt was so low. Well, now it's not, right? It's expensive, right? And it's not even necessarily easy to obtain. And so that debt flow is what's throwing all of these deals out of whack, right? It's poisoning the well of really good operations, good occupancy, right? Insurance costs have gone up, yes, and there's some challenges there with utility costs as well. But overall, multifamily is actually doing really well, except for if you have bad debt. If you have bad debt, the whole deal starts to get poisoned. And so
So
you've got to look at these three and figure out a way to time the market. And that's what we figured out.
I want to go back to you, bad debt. What is bad debt? Anything that's over 50% is bad
Um,
debt?
it's not necessarily, it only becomes bad if you're not cash flowing in a productive way that sustains the
Uh,
property in a healthy way with enough margin to have full-time property management. Ideally, you have 75 plus units or more or 100 units so you can scale the multifamily operations. If it's lower than that, you're doing it yourself, right? But you're able to still keep and grow the NOI through value add, appreciation. And so the debt, in other words, is leveraged for your friend. It's not just dragging down this plane that you're trying to get off the ground because it just keeps sucking out all of the NOI.
and what kind of margins are you looking at, that you would think would be healthy? I mean, is it 10, 15, 20%? But what's a good margin, if you will?
Yeah, so I think you got to look at a number of factors. Number one, you got to look at basis, right? The basis has got to make sense. So ideally, you're buying it below replacement cost, at the cost of construction and buying it. You're also looking at your cap rate. You have a positive arbitrage, meaning that your cap rate, let's say, is a 7 and you're borrowing at a 5. That's part of the challenge right now. Interest rates might be at 6 or 7, and cap rates are still maybe hovering there or lower. So it's either a neutral or it's negative, and that's not great. Whereas before it was like 3 or 4, and you can maybe buy a 5 or a 6, and you have that positive arbitrage. You're looking at cap rate versus interest rate. You're also going to look at the overall value add potential of growth, right? Because a cap rate is a static number, right? Meaning it's like a picture. It's not a video. An IRR is a video, it's a full motion, video of the deal, where cap rate is static. So you can't always just take cap rate at face value. You've really got to look at how much growth can I get per unit over a period of time? How quickly can I do that? Is there rent control in place? And am I ever going to be able to do this in a sustainable, way that it's efficient, right? And so those three factors you're going to look at. I'm always looking at cash on cash return, right? I got to get more than 4 or 5% because I can get that in T-bills right now, right? I've got to get ideally multiple digit returns on my cash on cash, at least over that 3-year period. Otherwise, what's the point? I'm taking on too much risk versus the reward. However, then you look at tax flow. You bring in tax flow and say, if I can depreciate something and offset my cash flow, well, that's a different part of the game here, right? I'm not just focusing on cash flow. I'm opening up the window here to tax flow. And if I can offset income by depreciation and cost seg, now I've opened up another ROI. Right. And now you're looking at debt. If you can assume debt, right, or refinance or fix it in a way that's going to get longer term in place. So these are the three kind of categories. And the mindset is looking beyond just the 1D, but going to 3D and trying to bring them together. And that's honestly where our strategy comes right into play. You can now time the real estate market, take on debt when it's your friend, buy deals when it makes sense, and still defer that capital gains tax, all without having to do a 1031 exchange.
There isn't necessarily a specific margin, rather than it seems like it's a multi-dimensional look at what margins are out there. So then, next question is, with only getting or taking on 50% of debt, in a deal, I think that someone said the average deal out there now maybe like $8 million or something like that, means you're going to get a debt, take on debt of 4 million and then have to raise 4 million. That seems to be a pretty daunting task, where most people are doing 75% debt if it's possible. I'm not sure if it is right now, but 75, 80% debt and then raising the other 20%. What is the I guess the rebuttal to people wanting to take on so much debt? I mean, why would I need to go raise 4 million when I can only just raise 2 million and get it done?
Yeah, so it depends if debt's your friend. And by the way, not that we wouldn't do a 75% LTV deal. We're just saying a conservative approach to looking back at what we've learned. If you've only ever did that, essentially, no matter where the interest rates went or what, debt that got, is floating at this point, you're going to be okay. It's when people took on too much debt and the rate adjusted like we're seeing now, and then we're seeing people lose all of it, right? And
Yeah.
so I think you've got to look at debt flow and a couple parameters for those who fixed their debt 2.5 years ago for 7 or 10 years, right?
Right.
They're just fine, right? They're just
Okay.
fine at 75% LTV because they've extended that life of the
Exactly.
timing of it, right? But
Okay.
for those who fixed it and took on, debt for a 2 to 3 year period and the rate caps are hitting, like they're going to lose it all. And so it's not a one size fits all. However, here's what I will tell you. We were basically in a 12 to 13 year bull market run. And a lot of people said we are at the height of the market. Something's got to give. I mean, most of us thought and felt that for years. And we kind of just, it's, a little bit like Russian roulette. Well, we keep rolling on the next deal, rolling on the next deal until the music stops.
Right.
And so when you're sensing that bull market run, you look at history, well, why don't you start to get out of some of that debt? Start to either or refinance and fix it for longer rates. Like
Yeah.
start to move away from just a cash flow and an appreciation play to like a debt flow hedge, right? And so you want to consider, and that's where, again, you've got to have timing on your side. You've
Right.
got to be able to move capital in and out of deals, in and out of debt without having to suffer the tax consequences of capital gains tax. And that's where we focus like a laser to bring these debt flow, this tax flow, and this cash flow together and make it like a flywheel that's seamless, where most people get stuck in one or the other, and now they're pinned to the wall, right? It's what we're seeing right now. And you've got to, strategic multifamily investing, you've got to be strategic on all three of those areas. Otherwise, you're probably going to get hurt. Like a lot of people are going to get hurt this year.
Yeah, I was talking to another guest, and they were talking about how over the last several years, most people were purchasing. They were not purchasing 7, 10 year money. They were doing, you had to do a bridge loan, right? Which is, kind of temporary money, which is only 3, 5 years maybe.
And
Hmm.
pause there. Why do they have to do a bridge loan? Because they had to compete with the other, frenzy of people overpaying for properties, not
Right.
looking at the fundamentals and paying and just feeling like I don't want to miss another deal. I don't want to miss another deal. And it becomes this self-defeating purpose of, oh, I won the deal. Well, did you really win the deal, right? Did you really
Right.
want that deal? Was it based upon the fundamental value of the deal and the cash flow and the tax flow and the debt flow and the overall, strategic plan? Or are you over pressing your skis here and you're going to start flipping down the hill? And that's the problem with what a lot of people bought, right? They
So
weren't
then,
buying on solid fundamentals that could have enough margin to satisfy all of the things that go in with multifamily management, with changes in insurance, with changes in interest rates, with changes in all of the things. And it's tough. And to be honest, we didn't buy a lot of multifamily the last couple of years. In fact, we were
okay.
lending to multifamily people. We
Yeah,
didn't make a
yeah.
lot of sense of it. I came from Taxifornia. Deals haven't made sense in a long time unless you combine the value add. And people did make a lot of money in the run up here. But for the last few years, we were shifting away from purchasing to lending and lending on 55% LTV, first positions, personally guaranteed. The particular fund that we lend in has never lost a single dollar, has never not paid 10%. And we've been waiting for this moment. And what's cool about this lending fund is we can get the money out in about 30 days. And
Hmm.
guess what? We can now go purchase these deals at a discount, which is the whole point, right?
Right.
Sell high and buy low and take on debt when it makes sense. By the way, I'm all about debt right now because prices have dropped by 30%. So to me, now it's a great time to take on, even though it's a little bit higher, well, we're going to get that 30% discount. Now,
But you're going to take on
ideally,
long-term debt, though. You're going to take
yeah,
on,
yeah, long-term debt, that's fine. I'd like a 3 to 5 right now.
oh, 3 to 5.
I
Okay,
like 3 to 5
that's
right now because I feel like we're probably at the the
the
point where
peak.
the peak of the debt. No one really knows, but I think it's more likely to go down in the next 2 to 5 years, right, than it is to go up. And so now backwards 2 years ago, I thought it was most likely to go up, right? So that's when I would want to lock it in. So it's not a one size fits all. You've got to look at this like in a Rubik's Cube. I use this scenario all the time. My daughter, she's
Hmm.
11 years old and she can make one color on one side. I still don't know how she does it, but every deal that shows up has these different colors on different sides. If you're watching this on YouTube, you can see it. And every single day, what we're doing, Jonathan, is just trying to move this in a way that aligns with our goals for our families, for our
Hmm.
impact, for our strategy, right? And all of that, ideally it lines up concurrently, but it's dynamic. We're in a dynamic world with AI, a dynamic world with speed and of information. But what I love about multifamily, it's that one solid core investment that we can make the most sense of, and it makes a big impact for people who need housing, and with the housing crisis that we have going on. So you collectively put all those things together, it's still the best risk-adjusted rate of return I believe you can get. Mobile home parks is really good too. I like mobile home parks and I like industrial as well. Those three are kind of our core that we try to focus on.
Got it. So you've been moving, you have not been purchasing very many multifamily over the last couple of years because you've been moving into debt. And of course, you wouldn't lose a dime if you're only doing 55% LTV. So that means you've got a lot of money that's coming to the table, right? And I know a lot of people were taking the higher debt, if you will, leverage. And so a lot of time there's a lot of pain still out there for some of those people that's going on. But then that represents, if you will, a benefit for you. And I know that you have a strategy, and we've talked about it, alluded to it so far. And we talked about 1031 exchanges. I'm familiar with them a little bit here. So if you could just explain that for everybody else. What is that and how has that been used, if you will, for people traditionally to grow wealth? And then how is your strategy then, we can then introduce your strategy and how that's different.
Absolutely. Thanks, Jonathan. And if you remember going to Blockbuster, right, back in the day, right, on a Friday night, and you've got to see that movie and it's up against the wall with that cardboard, right? And you walk in it right before you get it, somebody grabs that movie, and you're like, oh, this is such a bummer. I wish I could just, have unlimited amount of those movies. But even if you got that movie, you got to return it within 3 days. And if you lived in a place that was cold, you got to drive through the snow, you got to park, all I kind of have some nostalgia around that. But we call it the 1031 exchange Blockbuster. Like, it's the old way of doing things, right? And it does work, right? And it's tried and true. And 1031 can be amazing, but it can also be very frustrating because you have that 45-day window to identify. You have that like kind replacement requirement. You have to stay in the exact same asset class. You also have that replacement of that debt. You need to replace all of that debt on that next deal, right?
You have to stay in the same exact asset class?
Yeah, so you have to go
Okay.
multifamily or investment real estate to investment real estate, right? So
Okay.
in
All
that
right.
realm, but you can't trade crypto or a business and go into investment real estate or vice
Gotcha.
versa, right? You can't
Gotcha.
trade stocks. And so that limits your ability to time the different markets, right? To time the different markets. In fact, in 2008, guess what? It took 3 years for the real estate market to crash. 3 years, right? Now the stock market crashed within like a 6-month period or so, right? Like, it was a disaster, but 3 years for the real estate to finally get the full cycle. It's like a big Titanic ship that has to move. And so the key is you want timing on your side. So introducing the deferred sales trust, this is what we call Netflix, right? It solves a lot of those challenges. You don't have to do like-kind replacement requirement. In other words, you can sell a piece of multifamily real estate. You can move it into securities. You can move it into T-bills. You can move it into money market accounts, making 4 to 5%. What we like best, though, is moving into multifamily lending, making about 10%, right? For example, we did a $13 million exit for a client in San Diego. Now, they build car washes, okay? And so they bought some land for about $500K. They built on it for about $3.5 million. They sold for $13 million. And they knew, like, the market was, this is the hottest part of the market. They sold it and they paid off all of their debt, and they deferred about 40% of capital gains tax, because that becomes the big elephant in the room. If you don't solve for that, you can't sell and trade, because you're going to get crushed in your profits. And that's what the 1031 solves, but it doesn't solve the debt issue. It has you replacing debt. It also doesn't solve the timing issue. And so what we've done with this client is we sold high, we paid off all the debt, we got liquidity, we got diversification, and we're all tax deferred, and we're waiting to pounce on deals right now as these other values go down. And that's the whole concept. It's so simple. Sell high, pay off your debt, get tax deferred, get liquidity, get diversified, never have to use a 1031 exchange ever again. So that was a real estate sale, and they're going into lending, and they'll go back into real estate. That's what most of our clients do. They just time that market. But we've also had business sales. So we've helped, dentists, right? Healthcare professionals, right? People who are in different businesses and they sell. We did 11 million in Colorado in the last 6 months for a real estate sale and a business sale, and they deferred all of their tax, paid off all of their debt. And the same thing, we're waiting for the market to shift. In the meantime, we're in multifamily lending, and we're making about 10% on our money. And it also works for crypto. We did $13.5 million of cryptocurrency exits before the crypto crash. and we deferred the tax, and we invested into some businesses and some securities. And so any asset of any kind it works for. But the key of all of this is having a tax flow mindset and opening up the 12 freedoms. And these 12 freedoms are the ability to be an entrepreneur with the capital, because you can still run your own deals. You can still build your own deals, or you can be passive. You can go with someone like Jonathan, let's say one of his syndications or one of his deals, and you can diversify to that versus staying all into your own deal. We just did $10 million mobile home park in Idaho. And for him, he wanted the freedom of time and energy. He had worked his W-2. He had built up these 5 mobile home parks at 10 million. And he's looking up and he's going, this is starting to take up my time and energy. Exact opposite of why I got into this. He goes, but if I can sell it and I can actually increase my cash flow, decrease my risk, but ultimately open up my time and my energy, that is freedom, right? That's beyond financial freedom. That's time and energy freedom, right? And that's what the deferred sales trust offers.
So it is a trust. So let me go back for those who are like, well, what in the world is a 1031 exchange? 1031 exchange allows you to be able to exchange like kind, if you will, properties to defer capital gains, right? There's short-term capital gains, long-term capital gains. Short-term capital gains is if you sell something within a year. If you're over a year, that's considered long-term capital gains. Short-term capital gains is taxed at whatever your tax rate is now. Long-term capital gains is generally around about 15% or so, right? Did I get
It's
that
actually
right?
higher than that, right? So
It's
what's
higher than
interesting,
that.
as soon as you go over a certain amounts, Jonathan, right?
Ah,
Especially because most of the exits that we have, it needs to be $1 million net proceeds and $1 million gain. You're looking
okay.
at 20% minimum federal, and then you have
Oh,
the
wow.
state, and then you have Obamacare, right? And so, like for tax California, for example, you have 20% federal, you have 13.3 state, and you have 3.8 Obamacare, which is about 37% minimum. And then on top of that, you have depreciation recapture. So we like to say about 40% of the gain. New York, right, are heavier as well. New Jersey, very heavy. Illinois, all the bigger states. You have places like Texas and Florida that have no state cap gains tax. Tennessee, but they have that federal of 20. And so a good rule of thumb is at least 24 to about 50% of your proceeds are going to be crushed by capital gains tax and depreciation recapture, depending on how long you've earned it for, how much depreciation you've taken. And so it's massive amounts, right? And so we're
Right.
going to defer that tax. We're going to park it in this trust, and we're going to issue a promissory note to Jonathan. So Jonathan has a $10 million asset in California. He's owned it for 27 and a half years. It's fully depreciated. Well, if he sells tomorrow, he's going to pay 4 million of tax, right? Well,
Mhm.
instead of having 6, now he has 10, and this 10 is in the trust, and this 10 is owed to him, and we'll write a promissory note, the trust will, to you, and that becomes your new asset. You became a lender. Let's say we wrote it at 8%. That's on a million, on the 10 million, it's $800,000 of income. Now we're going to go invest it, and earn some income after fees. We pay you about $800,000. You're saying this is great. Before, your ROE might have been, $200,000 or $300,000. Who knows on the NOI there? Now you've increased your income drastically. If you had debt, we paid off debt. You deferred the tax, but the best thing is you got time back on your side, right? Which time is the number one crucial thing for all of investing. And your real estate mind can underwrite deals and say, you know what, I'm not going to 1031 because I'm not going to overpay for that. I'm going to let you guys all chase that deal. I'm going to sit over here in my blue ocean, in my calm seas, in my safe harbor, and I'm going to just lend. I'm going to wait. And
How,
then guess
how,
what? Yeah.
how is this trust different from, say, a revocable living trust
Yeah.
that, a lot of people have, and, they have their all LLCs and things of that sort. How is this trust different
Yep.
from that trust?
Yeah, great question. So a living trust has to do with probate. So each trust, there's thousands of different trusts, by the way.
Okay.
And the living trust has to do with, I want to make sure, Jonathan, I can pass my stuff or myself to my kids, right? If you have kids, I want to pass my house and my real estate and all my stuff. I don't want it to go through the courts. I want it to just go via what I want it. And it's just a seamless transfer to the next generation of ownership. Okay. That's a living trust. The deferred sales trust is
Mhm.
it's more like a C corp business trust. It's more like an LLC. Okay. It's an entity that you are selling your shares or your equity to in exchange for a promissory note. Just very similar if you just did a regular installment sale with a regular buyer, right? And in that
Gotcha.
scenario, the collateral is just the real estate. In this scenario, we're not going to finance the buyer. We're also not going to tie up our equity to the old deal, right? Which most of those traditional installment sales are maybe 4 to 6% interest rate. They pay you off in 2 to 5 years, but you can't go make money on your money. right? Like as an entrepreneur, that's why we don't like doing installment sales, because I want to take the capital and go make some more money, right? The
Hmm.
deferred sales trust gives you the freedom to be an entrepreneur with your capital, and I'll show how you do this like right here, right? So that back to the sellers of the I'll do another one. We did one in Tennessee for a client. He sold a $3 million business. Well, he wanted to build 70 multifamily units in Tennessee. Now, remember, businesses cannot 1031 into real estate. So he
Right.
1031 didn't even qualify anyways. But
Wasn't like kind. Hmm.
more than that, he just had land. So he needed to develop. He also didn't have a $3 million, equal or greater value, right? All the reasons the 1031 is blockbuster, right? So instead he goes, I'm not going to do blockbuster. I'm going to do Netflix, deferred sales trust. The 3 million hits the trust. And guess what? That becomes the seed capital to build 72 units in Tennessee, all tax deferred, him running the deal with a new LLC, which by the way, gets a new depreciation schedule of which he can get up to 80% of the depreciation schedule the way we structure it. This goes back to the tax flow engineering of all of this,
Hmm.
because in a 1031, your old depreciation schedule travels, which means you have next to no or little depreciation. Every time you 1031, you have less and less and less.
Hmm.
Therefore, you have more and more and more tax. So what you want to do is reset the depreciation schedule, and that's what we offer. And so people's heads at this point explode, Jonathan, because they go, this is way too good to be true. My CPA would have known about it. I've been the best in the business. And you've done 200 podcasts. You've had all the major people on there. And I go, I know. I felt the same way. I was at Marcus and Millichap. We thought we were the Navy SEALs of investment real estate brokerage and 1031 exchanges. And we learned something new. But it took the 2008 crash to be, I guess, open enough. There's a quote by Ray Dalio that pain plus reflection equals progress. And we had a lot of pain in '08, and we had a lot of reflection in '09. And guess what? I learned about this in '09, and we started to make progress about how we can help to never have this happen again. And here we are, right? And we're still just getting the word out. Like, in fact, we have the brand new book, Building a Capital Gains Tax Exit Plan, and it hit #1 bestseller with Kevin Harrington from Shark Tank. Like, we're still just trying to scratch the surface of the old 1031 industry. We want to help all of our commercial real estate people out there. That we love commercial real estate. It's who we are, and we love multifamily in particular. But if you don't have a team and a strategy that's innovative and that's flexible and gives time on your side, you're playing in Blockbuster when you could be in Netflix.
Gotcha. So then how do people get in contact with you to learn a little bit more about this or, because there's going to have to be a lot of re-education, for a lot of people in terms of, their understanding about how they exit from properties and in deals that they're working on. How do
Yeah,
they reach
well,
out to you?
two things. Number one, we have the best 1031 exit plan we just released. Okay. Friends don't let friends 1031 without a backup plan. And we, with the deferred sales trust, we can provide that parachute in case your plane starts going down without having to identify it. You should never, ever use a 1031 exchange accommodator or group that doesn't allow the traditional 1031, the Delaware Statutory Trust, and the deferred sales trust. And we're the few of the entire country who've done all three and are experts in all of them. And so we want to make sure that you're using that. You can go to experttaxsecrets.com to get started on the best 1031 exit plan. So whether you're a broker or you're an investor, please, whatever you do, we get calls every week from people who are with these other accommodators that are just practicing blockbuster methods. Don't go with an accommodator that just blockbuster. Go with one that gives you blockbuster and Netflix. Okay, so that's us. The other place for the deferred sales trust, just to get started right away, is to go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. You can also search that on Facebook, on YouTube. We have over 500 videos of us breaking this down, client success stories, how it works, all the things that you might be thinking it's too good to be true. My CPA would have known about it. How is it legal, right? How do we structure the promissory note? How do we have the controls with a third party unrelated trustee? That's our role. How does it work with our broker? All of it's there. Just go to capitalgainstaxsolutions.com to get started.
Okay. Well, listen, thank you so much, Brett, for coming on and taking the time to do this. And I hope that people who happen to be in that situation and are now ready to take advantage of some of these opportunities that are going on this year and the next couple of years to reach out to you to develop those exit plans. Thank you so much again, Brett.
Absolutely. Thank you, Jonathan, for having me.